Welcome to our video on balance sheet-oriented economic policy. Dr. Andreas Bergmann, Professor of Public Finance and Director Public Sector, will explain how balance sheets can be used to enhance the design of economic policy interventions. He will highlight the implications in the current COVID-19 crisis.
Thank you for joining me in this video session about balance sheet-oriented economic policy. People often ask me, what is the government balance sheet actually good for? Now, the obvious answer is it's good for accountability purposes, but also for decision making. In times of the crisis like the one we have right now, decision making obviously becomes the key priority. Therefore, we will focus on decision making now. But let's first have a look at the impact of the COVID-19 pandemic. Of course, it is, before everything else, a healthcare emergency. It results in an unprecedented surge in demand for healthcare, and in particular for diagnostics like tests, for personal protective equipment like face masks, for ventilators in hospitals, and in some cases even for entirely equipped intensive care units. But then it's also a deep recession. According to the International Monetary Fund, it is the deepest recession since the Great Depression starting in 1929. Now, what does that mean? Well, it's a combined supply and demand side shock, which is, and this is new, mainly due to measures containing the pandemic, so doing something useful from a health perspective. But of course, the lockdown results in a deep dive of the gross domestic product. The IMF estimates it will be at least 6% less than in the previous year. And in many countries, it could actually dive more than 10%. Unlike the Great Depression in 1929, or also the global financial crisis in 2008, it is not a financial crisis. It is an economic crisis. As a professor of public finance, I'm obviously not giving any advice on the medical side of the pandemic. But I have a look at the economic effects and in particular how we can reduce or at least shorten the deep recession we are facing. The International Monetary Fund is suggesting the use of a combination of monetary and fiscal policy. I completely agree with this recommendation. Because of the magnitude of the crisis, we need to use all measures which are available and useful to protect the economic well-being. The monetary policy is particularly useful in the short term because it provides the liquidity to corporates and to individuals, and it stabilizes the financial markets. But there is very little room for a longer-term monetary stimulus because central banks' balance sheets are already very big, and this because of the previous crisis, the global financial crisis we had 12 years ago. So that's where we have to have a look at fiscal policy. Now, also in short term, fiscal policy is necessary to cushion the impact on the most exposed households and businesses and to preserve economic relationships. This means we have to provide unemployment benefits, for instance, to those who can no longer go to work, or we need to provide liquidity to businesses in order to pay their invoices and their rent. But it's also very important that we protect economic relationships. We need to make sure that our businesses maintain their customer base, which might be abroad and cannot be visited physically, at least in the short term. When it comes to the longer term, we need to support aggregate demand. So we need to make sure that the economy gets jump-started and therefore recovers more quickly. Before we have a closer look at the balance sheet approach itself, we need to understand how economic policy has traditionally been designed. For many years, economic policy was mainly about flows, and in particular about cash flows. So monetary policy was about flows in financial markets, and fiscal policy was about government revenues and government spending. An important part of the fiscal policy were automatic stabilizers. Automatic stabilizers are schemes which are increasing the spending automatically during recession and reduce it again once the recession is over. A good example are unemployment benefit schemes, which obviously pay out their benefits when people become unemployed because of recession and reduce their payouts once people get other jobs and go back to work. Therefore, the primary effect of fiscal policy is on the statement of financial performance. And this is usually a deficit. Why is it a deficit? Well, because governments have to increase spending during the recession and also face lower revenues, for instance, tax revenues. Therefore, it is normal that governments go into deficit. Obviously, at the end of the recession, their spending should go back to normal again, and revenues should increase, and therefore the government should go back to a surplus. Now, during the recession, and unfortunately sometimes also in other economic situations, governments do not have the necessary cash to spend and therefore have to borrow. This obviously increases government debt and therefore is something which is a longer-term effect. Now, the balance sheet approach offers some new options when it comes to designing economic policy interventions. The approach was first mentioned in early work after the Asian and Mexican financial crisis in the 1990s. The International Federation of Accountants, with its public sector committee, developed the concept of government balance sheets, and a group of economists led by Mark Allen of the International Monetary Fund developed some economic concepts to use the balance sheets of governments in designing economic policy interventions. Thereafter, this approach was no longer mentioned that often. However, in the aftermath of the global financial crisis, I could show that indeed some governments had used this approach and actually did so in a very successful way. Why was it successful? Well, all governments, those using the balance sheet approach and those not using the balance sheet approach, rescued a number of firms, of banks, of car makers, and invested large amounts of money. Now, some of them did by using grants, so by handing out money to those industries. Those using the balance sheet approach, however, invested in those companies or in some rescue companies created for that specific purpose. And because the balance sheet approach does not forget about such interventions, they later on recovered the amounts invested. After the crisis, the value of those corporates and also of some of their assets increased sharply. And this was the very moment governments using the balance sheet approach could disinvest and recover their earlier investments. In some cases, in the longer term, they even did so with a gain. So over the entire period, there was no loss to the government, but a gain. In 2018, so only 2 years ago, once again, the International Monetary Fund became interested in the balance sheet approach. However, this time, not only in the case of a crisis, but for general use of governments. Therefore, I think the IMF Fiscal Monitor published in the October 2018 was really the main step for mainstreaming the balance sheet approach in the design of fiscal policy measures. I'm not entering into all the details of the 2018 Fiscal Monitor report published by the IMF, but I would like to show that the report touches on topics which are really important in the current situation during the COVID-19 recession. Firstly, the report looks at fiscal risks and how balance sheets can be used to assess fiscal risks and also to better manage fiscal risks, in particular related to public corporations. The report also shows how fiscal policies can be evaluated in the light of changes in commodity prices, in the light of investments, or generally in the light of the intertemporal development of net worth. Finally, it also shows how the balance sheet should be guiding fiscal policy in terms of balance sheet management, but also in terms of fiscal risk management. So let's have a look how the balance sheet approach can be used to design economic interventions. Firstly, let's be totally clear. Interventions always have to achieve a specific economic policy goal. And this economic policy goal is never defined by the balance sheet approach itself. So, for instance, governments want to cushion those most vulnerable in the case of an economic downturn. This is an economic policy goal, but the policy goal is not defined by the balance sheet approach. However, the balance sheet approach is then, in a next step, offering different design options for economic interventions. In particular, using the balance sheet approach, governments should consider 4 aspects. Firstly, they should ask themselves, is cash actually needed to resolve the problem? Sometimes it is, sometimes it is not. Then governments should have a look at assets. Is it possible to acquire assets? Thirdly, could the balance sheet be used to mitigate risks? And finally, are there any financing options which would not increase the debt level? Interestingly, some of the multilateral development bank programs published in the recent days actually focus on fiscal policy design, so exactly on what the balance sheet approach is all about. Now let's have a closer look at those 4 aspects the government should consider when designing economic policy interventions using the balance sheet approach. Firstly, is it really necessary to have government cash expenditures to achieve an economic policy goal? The answer is, well, yes, sometimes it is necessary. So if we think about unemployment benefits or partial unemployment benefits, which of course have to be cash transfers to those affected because they no longer have an income and therefore need some cash out of the unemployment benefit scheme. But sometimes it is not necessary to have cash expenditures, at least not immediately. For instance, governments can offer deferred tax payments, which of course reduces their cash inflow, but does not create an immediate cash outflow. They can also use financial guarantees or credit facilities, which are, at least in the short term, not creating a cash outflow. Of course, later on, they might actually lead to a cash outflow if the credit facilities are used or if the financial guarantees are deployed. Also, in-kind donations are something to consider. Governments have many resources, assets, which they can use for donations and therefore do not create a cash outflow. And of course also the free use of existing infrastructure. So for instance, if a gym is converted into a temporary hospital, does not lead to a cash outflow. Additionally, multilateral development banks offer non-reimbursable facilities. So they offer facilities which can be used and do not have to be paid back. The World Bank and also some regional development banks have recently offered such facilities to those member countries which are in a weaker position economically. Now, the second aspect governments have to consider is whether they can obtain an asset or actually reduce one of their existing liabilities in exchange for the cash. So sometimes, yes, they have to spend cash, but at least they should make sure that they acquire an asset with the cash or reduce one of their liabilities. Now, how does this work? For instance, if governments invest into property, plant and equipment, so for instance, when they purchase ventilators or lab equipment, this leads to an acquisition of assets. And the effect is that depreciation charges spread the economic cost over the entire useful life of the respective assets. So it's not affecting only 1 year, the year 2020, but it is affecting all years during which the asset can be used. Another case is the temporary nationalization of companies, for instance of airlines. Now, if governments nationalize companies and do not only provide grants, then of course they take control of an asset. They take control of the airline in that specific case. And once the crisis is over, governments can once again privatize the airline and recover the money invested. And as I have shown before, quite often can recover a larger amount of money because after the crisis, the value of the company, in this case of the airline, has increased. In some cases, governments can also convince lenders or suppliers to forgive debt. Sometimes, or in most cases actually, this is only a partial debt forgiveness. So not the entire debt will go away, but at least some of the liabilities can be reduced in such a crisis situation. The third aspect governments should consider is whether they can use the balance sheet to reduce or share risks. Now, governments do not necessarily have to bear all risks themselves. For instance, they can assess whether it is economically feasible that companies which are to be rescued can actually operate profitably under normal circumstances. So they should be able to survive if there was no crisis. Of course, this reduces the risks of government interventions if such an assessment is done before the company is being rescued. Governments can also match maturity of assets and liabilities on their own balance sheets. This is actually what Mark Allen in this very first paper proposed as the main use of balance sheets. So if the maturity of the assets and the liabilities are the same, then of course there is less financial risk associated with the balance sheet. But sometimes it's also possible just to share risks. So for instance, when governments decide to provide loans not by themselves, but through commercial banks, through the banking system, they make sure that some of the risk is actually borne by the banks and not the entire risk is borne by the government itself. Or they can require those companies rescued to reimburse the loans before they actually are allowed to pay out dividends or other profit shares, and therefore also take some of the risks of the economic intervention. Finally, the balance sheet approach considers whether there are options to finance the intervention without increasing government debt. Now, in many cases, there are options, but just as a warning, not all options are actually not increasing government liabilities. So we have to be very careful in this field. Some options include equity offerings. So this is in particular the case when state-owned enterprises are being used, and those state-owned enterprises are able to raise some additional funds by issuing equity, by issuing shares. This is, of course, an option which does not result in higher public debt. Another option is if liquidity is provided by the central bank through the banking system and not by the government. Now, of course, if the central bank is consolidated, which is the case only in some of the countries, the consolidated balance sheet will be affected, but at least there is no direct effect on the government's own balance sheet. Finally, governments can also issue investment incentives, so incentivize private sector investments, and then of course there is also no effect on government debt. But of course there might be a reduction of government revenue, for instance, if tax incentives are provided. A very clear warning should be made when we consider public-private partnerships and financial leases, because of course those facilities are increasing government liabilities and therefore do not result in the effect which is desired. So what is the effect of such a balance sheet approach design used for economic policy interventions? Well, obviously the primary effect is a stronger balance sheet going out of the crisis. But this is not a means in itself. Therefore, secondary effects are perhaps more important. It's very clear that a stronger balance sheet means that there is less burden for future generations. So it helps future generations to deal with their own challenges. And of course, there is very strong evidence that governments with a strong balance sheet have more capacity to absorb future economic shocks. So, for instance, shocks created by future pandemics. Therefore, it is recommendable to always consider the effect on the government balance sheet before deciding on a particular design of an economic intervention. It does make a difference for future generations. I hope this short video has given you some insight on how economic policy interventions can be designed using the balance sheet approach. A strong recession like the one caused by the COVID-19 pandemic requires strong economic interventions. However, using the balance sheet approach makes them more feasible and more sustainable in the long run.
Thank you very much for watching this video. If you have any questions, please visit our website at www.zhaw.ch/IVM or contact Professor Andreas Bergmann directly.